Thanks for clicking! The Canadian government is going to be allowing 30-year amortizations for first-time homebuyers on the purchase of new build homes, and allowing first-time homebuyers to take out more money from their RRSPs. This according to an announcement coming from Finance Minister Chrystia Freeland.
This is huge! Wait a second.
Not really. But the announcement from Freeland comes as Canada is indeed facing an affordability crisis, with nary a day going by without some new report showing how the rapid increase in prices brought on by free money and low supply has made homes unaffordable for Canadians. But fear not, Freeland said in her statement that she hopes the new measures will bring comfort and hope to young Canadians. Yet, a closer look, or even a passing look, at the measures show that they probably won't have that big of effect on the housing market or affordability.
Feed them shit and keep them in the dock.
So what I want to do today is go over the new measures announced by Freeland, take a look at the extent to which they could change the housing market, and then discuss some implications. What could have an effect on Canada's housing market is interest rates, and we are expecting to get Canada's CPI released next week, which could have an effect on the Bank of Canada's ability to cut rates in June. We will obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these amortizations. Onto the 30-year amortizations. First and foremost, as a brief aside, I've seen a lot of social media posts from mortgage brokers, from the usual suspects, from misleading headlines, noting that the new rule changes will allow first-time homebuyers to use 30-year amortizations, without adding in the caveat that it's only for new build homes. I don't know if the articles explaining the program just weren't read, or if this was a purposeful bait and switch. If it's the case that these posters just didn't bother to read the article, the CBC article outlining the program was a total of 334 words. Given that the average adult can read at a pace of 238 words per minute, take the minute and a half and read the thing before referencing it.
I'm not doing too much. I am not doing too much.
If, on the other hand, it was a purposeful bait and switch, even OMVIC, Ontario's car dealer regulator, has measures in place outlining bait and switches, just so you're clear about what you're doing. End of rant. As mentioned, Freeland announced on Thursday that first-time homebuyers getting an insured mortgage, those with less than 20% down, will now be allowed to extend their amortizations up to 30 years. Previously, and still really, the maximum amortization for those with less than 20% down, insured mortgages where borrowers have to buy the mortgage insurance from places like CMHC, was 25 years. However, under the new system, if borrowers have less than 20% down, they can now extend that amortization up to 30 years, so that more younger Canadians can afford to pay that monthly mortgage on a new home. So the real question becomes, how much more affordable, how much more buying power do these new rules allow, which are set to take effect on August 1st?
By then it's going to be too late.
As an example, let's take a look at a newly built home in London, Ontario, listed for $949,900. Under current rules, using a decent 5-year fixed rate of 4.99 minimum down payment requirements and of course a 25-year amortization, borrowers would have to earn roughly $225,000 a year to be able to afford that home.
Is there anything else we can do to help?
Well, let's see. Keeping everything else the same, down payment, taxes, rate, etc., but using a 30-year amortization, borrowers would now have to earn $215,000 to get that newly built home.
You've completely changed my life.
So yeah, for those younger Canadians about which Freeland was speaking, those younger Canadians making $215,000 a year who couldn't quite make that leap into home ownership, they'll be much better off. Now, obviously, there are some cheaper options in London. Not all new builds are going to be $950,000. There is a one-bedroom condo available for $531,000, but you get the idea. The buying power only changes about 5% under these new rules, under the 30-year amortization. So, is this extra 5% in buying power at the upper end of the market going to be enough to drastically move the market?
Doubt it.
Well, according to Kevin Lee, CEO of the Canadian Home Builders Association, the extended amortizations are expected to lure more homebuyers into the market, counteract high interest rates, and support prices, which will stimulate more construction. But is that the case? Is a 5% increase in buying power going to be enough to lure buyers into the market, counteract interest rate, and support prices? I don't know. Let's do some research.
The f*** is that?
Let's do some research on what has been said about extending the amortizations in the past, what has been said by those who had no financial interest in the outcome. In 2019, Evan Siddell, then CEO of CMHC, which will now be insuring these loans, said that increasing amortizations was a dumb idea, noting it would increase demand and increase debt.
That's what we're looking for.
So, on that front at least, if the idea is to create more demand for newly built homes, then CMHC says it could very well work. I should also note that the former CEO of CMHC made headlines in 2020 for predicting that house prices were going to drop by 18%, which obviously they did not during the pandemic. Laurent Chambry, Deputy Governor of the Bank of Canada, once noted in a speech that lowering amortizations down to 25 years increased credit scores and improved the quality of mortgage borrowing, which makes sense if borrowers have less than 20% down and need that extra 5% in buying power brought on by the 30-year amortization, insured by all of us, then they're already probably at the max of their buying power. So I suppose on that front that the argument would be that that extra credit risk is worth it if it entices builders to build more homes.
Well, you gotta do something.
Now, I'm obviously not an expert in the financials of home builders, but in doing the research for this video, I found an article from way back in 2015, back when the benchmark price was $411,000 and a decent 3-year fixed rate was sitting at 4%, and the housing industry was expressing its usual genuine concern for first-time homebuyers. Back then, in that article, the Canadian Home Builders Association had made a submission to the federal government asking for increased amortizations, while also lamenting affordability and rising costs. Back when the benchmark was $411K and interest rates were at 4%.
Tough times.
Which obviously begs the question, if home builders needed an extended amortization back in 2015, back when the benchmark price was $300,000 less than it is now, and interest rates were at least 1.5% less than they are right now as well, and the CHBA was still lamenting affordability, then will that extra 5% in buying power, which won't even come close to returning the housing market to similar conditions we had in 2015, do that much to change affordability? Do that much to change the overall housing market? Now, it could very well be that those 2015 pleas were self-serving, what's the word?
Bullshit!
Thanks, Hugh. But the point is that the CHBA has been looking for these longer amortizations for a very long time. It's been looking for these longer amortizations even back when conditions were much, much, much easier. Alongside these 30-year amortizations, the government is also allowing first-time homebuyers to withdraw up to $60,000 from their RRSP, up from the previous $35,000 limit. This will obviously help with down payments, but is it going to make the real estate market any more affordable? Maybe marginally for some buyers, but it's definitely not a game changer. And the reason, of course, that neither of these two measures are game changers is that they can't be. The government knows, we all know, that any measures introduced to increase demand that would, in theory, make the housing market more affordable for first-time homebuyers will do nothing but push up prices. And the government knows this. We all know this. We all, for the most part, know exactly what the problem is. The problem stems from the pandemic, where the government, where the Bank of Canada, printed up a whole bunch of money stating that they were going to be leaning on the real estate market, prices shot up through the roof, and they've never returned to those pre-pandemic levels. And to a certain extent, they can't. And the reason they can't is that if prices return back to pre-pandemic levels, all of those banks that lent out all of that money during 2020, 2021, and the beginning of 2022 would see the value of their assets massively devalued. And then the government has a bank problem. We all know that that's the problem. In the aftermath of the pandemic, we obviously did see a lot of more newcomers come to Canada, which has put major pressure on supply. But the real problem is that house prices got artificially bid up during the pandemic, brought on by free money, and now, were those prices to drop back down to where they should be, where they would have been were it not for that free money, then we would have a serious banking problem. I'm not sure what the solution to that problem is, but it's certainly not giving first-time homebuyers who got shut out of the market because they were unlucky enough to be in a position to buy during the heyday. The solution is not to give them false hope and clickbaity headlines. With that said, the Canadian budget is set to be released next week, and if we get any more news on mortgages or the housing market, we'll obviously have an update out on that budget on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.